So, without further ado, where is crypto headed? And we are going to talk about the three Ds, uh, DSOC or DSOC, to be determined how that's pronounced, DPIN, DSci. If you have no idea what those means, I will explain it, restaking, and some other trends. But first, we are going to start with a quote from Ryan Selkis, founder and CEO of Messari, a crypto research firm. This is from his most recent Crypto Theses 2024. If you believe, as I do, that blockchains are accounting innovations at their cores, then all assets will eventually be crypto assets that trade on public blockchains versus legacy clearing and settlement systems, whether they are utility tokens or security tokens. Over time, the Venn diagram of crypto versus TradFi looks more like a circle. I just, I love that he refers to blockchains as accounting innovations because that's truly what they are. And we're starting to see this. We're starting to see the Venn diagram of TradFi and crypto look more like a circle, especially with the spot Bitcoin ETFs launching. You see more big players starting to integrate digital assets into their operations, go beyond just holding them on their balance sheets. All right, so the three Ds. This is a super interesting topic, and what we're really starting to see here is we had DeFi, which is obviously decentralized finance. I think that was a very obvious use case right off the bat with crypto and digital assets. Now, what we're starting to see is the decentralization of non-financial assets and non-financial systems, which is really exciting. So the same way that DeFi transformed finance, DSOC, DPIN, and DSci are changing social media, physical infrastructure networks, and science. So again, this is probably DSOC, but I'm just so used to seeing SOC report. So decentralized social networks are networks where user data and content are stored on a blockchain rather than and independent servers rather than centralized servers and by a single company. We'll talk about why that's even needed in a second here, and that Web3 social networks use those blockchains to store and manage the platform data and the content. DPIN are decentralized physical infrastructure networks, which is the name for blockchain networks that use tokens to incentivize communities, not corporations, to build. You can tell that I copied and pasted this from somewhere because this is the UK spelling. I would never do that. To build physical infrastructure networks, think mobility, electric vehicle charging, and telecoms, et cetera, from the ground up. Decentralized finance, or DeSci, is a movement that aims to build public infrastructure for funding, creating and reviewing, crediting, storing, and disseminating scientific knowledge fairly and equitably using the Web3 stack. So that's just a quick preview of the three Ds. Let's dive in and talk about each of these a little bit more specifically. Decentralized social media. So first question is why? Why even have decentralized social media? And there's a couple of reasons for that. Up to this point, social media has been dominated by a few specific players. You have Facebook that owns really more than 50% of the market between Facebook and Instagram, TikTok, YouTube, Twitter/X, and then there's a few, smaller incumbent players. That industry is worth 200. They brought in $230 billion in revenue last year. So a couple things with social media. one thing we've seen a lot in recent years is deplatforming. So a creator might work their whole lives to build up a following on social media, and that could be their livelihood. And suddenly having that their account closed down, and essentially everything is lost. Two, we've seen censorship where you kind of just have to abide by the rules of whatever the company that manages the platform has said. Um, and we've even seen some pretty big scandals with, for example, Facebook. I mean, really all the platforms of gathering our data, going and selling that data without our consent. So there's a lot of reasons why decentralized social media is appealing. I list out some of the benefits here, but privacy, security, data ownership, censorship resistance. Some of the drawbacks are attracting users. It's really difficult to bootstrap and sort of grow like a grassroots social platform. They're a little bit more complex. The current platforms are not super intuitive, at least compared to Instagram or Facebook or Twitter. Um, they lack certain features, and scaling can be tough because you're using blockchains that require gas fees. Some of the popular platforms are Farcaster, Friendtech, and Lens. You've probably heard a lot of excitement on crypto Twitter and elsewhere on Farcaster. Friendtech kind of popped off at the end of 2023. Here's that slide a little bit bigger. So I won't go through all of this. Also, I have a lot of Messari slides in here just because they do such awesome research. And I figure I'm not going to reinvent the wheel if they've already put a lot of it together. So one thing I wanted to focus on is the key tailwinds are ownable content, right? Creators are incentivized directly to share content on the platform. It's not an ad model. A lot of the time they just get paid directly for providing content. Social investing. Some of the headwinds are you don't see a lot of super successful crypto apps on mobile, and then just data exhaust. So social apps produce tons and tons of data. So to store even some of that on chain can be a little bit expensive. And if any of these chains were to suddenly gain a huge following, it would probably cripple them because they just need to have the infrastructure and be able to support that many transactions, that much data, especially going through the blockchain. Here is an overview of the decentralized social market map. So really there's the base layers, which are blockchains. You see a lot starting to be built on layer 2 chains like Optimism, Arbitrum, Coinbase's Base, basically just because they have lower fees. You have content storage, so we'll talk a little bit about that in DPIN, hint, hint. Social graphs. So this is kind of like the next layer, the social graph protocol, the application infrastructure. So content management, messaging, payment streaming, and then the front ends that you're actually reacting with. So that's kind of the map of decentralized social media. So I wanted to share a really quick example. So Farcaster is a really interesting system how they've set it up. So it's built on the OP mainnet, so it's on Optimism, and it's a hybrid model where some of it is on chain and some of it is off chain. So some of the things that are on chain are creating an account, paying rent to store data, and adding account keys for connected apps. The majority of user action, so really anything that like requires data privacy, anything that's like more transaction related, they keep on chain. The majority of user actions are performed off chain. So posting a new public message, following another user, reacting to a post, those are all done off chain. So you can see how this is kind of laid out in the graph here. Friendtech is another example. So this is built on Base, Coinbase's layer 2 that they built out. This one is a completely different model where you can essentially buy shares in creators. The way I've heard it explained is kind of like NASDAQ, but for trading different creators. It's pretty interesting concept, but for example, if you really like a certain crypto influencer and you want access to their following, and you also want direct access to them through like a private chat, you can buy some of their shares or keys. You can also sell those shares. So if you think, you know, a creator is going to just start taking off, you can buy it for speculative purposes and then sell it for a profit. Every user is like a social token, so you can buy that social token, sell it for a higher price, keep holding it as the token appreciates in line with the user's credibility. Take a quick drink here. All right. And I'm going to talk about the accounting and tax implications for all of these once we get through the 3 Ds. And if you have questions, be sure to jot them down. We'll save some time for questions at the end. So the next one is DPIN, which stands for Decentralized Physical Infrastructure Networks. So cloud infrastructure, there's another pull up, by the way. Cloud infrastructure services are a 5 trillion market cap sector, and DPIN accounts for 0.1% of that. And essentially what DPIN is, it's their physical resource networks that incentivize the deployment of location dependent hardware to offer real world services. So what's an example of this? It's like I'm already blanking on. I had an example. Oh, so an example of this would be a lot of people have heard of Helium, right? Where Helium is essentially a wireless network where you could basically agree to. I'm not sure if it was like using your computer, but you could essentially become a wireless provider by installing certain software on your and giving up your compute power to become a wireless provider. Another example would be like you've maybe seen the Google Maps cars driving around with all the crazy cameras. Decentralizing that and saying, hey, you drive Uber, why don't you throw some cameras on your car and go drive around, take pictures so you can make maps, or go gather traffic data around, you know, downtown Los Angeles, and you get paid for that, and it's all managed through smart contracts. So there's wireless networks is one category, geospatial networks. So having different systems or sensors kind of distributed across the world. They capture and record data related to the physical environment. Mobility networks, so everything around vehicular data, and then energy networks as well. So collecting data around real-time energy consumption, things like that. So some of the benefits of DPIN is their decentralized control, system resilience, and equitable resource access, sustainability. Some of the drawbacks, there's some regulatory hurdles, scalability limitations, and interoperability challenges. Some of the popular platforms are Akash Network, Render Network, Filecoin, Helium. Here is a map of the DPIN sector. So you'll see wireless networks. Here's Helium, the 5G network that I mentioned, IoT networks, Wi-Fi networks, geospatial networks, mobility, energy, storage, compute. The compute one is really interesting because, and one use case that I've seen talked about quite a bit is with the obvious popularity of AI. AI requires a lot of compute power, which is something that is pretty scarce. So we all have compute power that we're not using, both as individuals. Companies have compute power. I once I once met a guy that was like the IT administrator at a university. I won't say which one or who, but he used all of the computers at the school to mine Bitcoin. So kind of that idea of like, hey, if you have extra compute power that you're not using, even if it's just at night, why don't you turn those on and start to gather data, start to let us use that compute power to process large language models. There's lots of really cool projects happening in this space. So a few fast facts on DPIN. So there's physical resource networks, PRNs, and digital resource networks, DRNs. And Messari predicts that DPIN could add 10 trillion to the global GDP in the next decade and 100 trillion the decade after. So there's a lot of room for this to grow. And it generates more than 15 million in annual on-chain revenue. And this number is set to grow rapidly in the coming years. So this is different than a lot of use cases we see, because we see some use cases where there's a lot of hype, not a lot of revenue generated on chain. It's more just a like utopian idea that we hope takes off, but this is already generating revenue on chain. You can see a couple more of the sectors here: compute, wireless, wholesale data, service marketplaces, energy services, vertical ad networks. So lots of really cool things happening in the DPIN space. Decentralized storage. This is probably one that people may be more familiar with. But I thought this was fascinating, that decentralized storage networks range from 70% storage or 99% Filecoin, cheaper than Amazon S3. So it's a lot cheaper to store data on these decentralized servers. That being said, they are not perfect. They're a little bit slower right now. They don't have quite the they're not quite up to par in terms of like Amazon S3, but they're getting there quickly. So that is DPIN. And then finally, we have DeSci. So this is decentralized science, which a really big challenge, and I did not really know anything about academic research, and especially in the field of science. But there's this big problem that really anyone that's close to that space knows as the valley of death. So a lot of this research starts out in academia, and it's just basic science, and then you're kind of trying to, there's this valley of death where you're trying to put this science, go from theory to actual like application clinical science, and a lot of ideas that are formulated in academia sort of die out in this valley of death because it's really difficult to get funding. Um, there's all these like hoops you got to jump through. Um, so there's lots of issues that need to be overcome there. Um, so DeSci aims to overcome traditional science's valley of death by facilitating more efficient peer review processes, addressing intellectual property issues, reducing gatekeeping in publishing, and offering new funding models. I saw something that I think it costs like uh, $20 to rent a research paper for uh, like a couple hours. So um, pretty interesting. Blockchain's role in this is it's a more open and decentralized approach to scientific research. Um, so you mitigate some of the gatekeeping in publishing. Um, you mitigate the high fees, the slow dissemination of knowledge. It becomes a lot easier to do peer review. You can set up smart contracts to make sure that the IP is protected or NFTs. Um, Popular platforms are VitaDAO, AthenaDAO, and Genomes DAO. If you want to go check out some of those projects, this is the ecosystem. So there's funding arms, research, review, publishing, data collection, management, communities, art, inference services. So this is a growing sector for sure. All right. So you're probably wondering, what does this mean for for me from a tax and accounting perspective? Um, and I really did not get too deep, too technical on this because I'm not the AICPA. I'm not a Big Four firm. Uh, so this is just kind of some of the beginnings of the implications um, that I'm really just coming up with off the top of my head. So they could be totally off. But hopefully it gets you starting to think about some of these issues. Um, One thing that I is immediately apparent with this is we're going to see a lot more microtransactions, um, meaning that like in all of these instances, like for example, if you're in the Google Maps example, if you're driving a car around with cameras on it and getting like geospatial data, um, maybe you get a couple cents like per mile driven, which will obviously be a nightmare from an accounting and tax perspective. Um, there's revenue recognition issues there as well. Um, on decentralized social, like are you getting paid every time that you post a small amount? Are you getting paid based off of engagements? Uh, so on we'll kind of go through each one of these here, but decentralized social, there's ongoing fees to store posts and engagements. You have to pay fees per post, at least on Warpcast, which is the kind of the Twitter equivalent on Farcaster. So you pay basically one, you basically pay a cent per post. Um, so if you have someone that's really active on decentralized social platforms, you're going to have a lot of expenses to recognize. Blockchain fees for using frames in the app. So interesting thing with Farcaster is there's something they just released called Frames, where you can actually go and like buy NFTs. You can go do certain things directly in the app without ever leaving it. It'd be like if Twitter had like Uniswap's interface. There's another poll question up, by the way. So go answer that. Buying and selling shares on Friendtech has some interesting implications. I already mentioned this one. Smart contracts for revenue sharing, user participation incentives, and NFTs being used as content. So DPIN, there's some really interesting things here around revenue recognition for timing and amounts, especially if it's you've just got your your computer running using compute power. At what point do you recognize revenue um, for delivering that service? So these are completely novel systems and transactions. So there isn't really a rule book in terms of when you recognize that revenue. Um, Multiple element arrangements. So with DPIN, sometimes you get paid just in that native token. Sometimes you get access to different network services, voting rights, shares of earnings. So you can have these contracts that actually become really complex because you're not just getting cash, you're not just getting crypto. Um, Deferred revenue recognition over time. That's another big one. Valuation of tokens, tax implications for contributors. So on the supply side, again, if you have all these computers that are just sitting and you end up using them to offer compute power, then you're going to start gaining these little tiny like microtransactions of income, uh, which you have to recognize as, we're assuming you'd recognize as ordinary income. And then when you sell those tokens, you would have a capital gain or loss to recognize. So that could certainly complicate the tax situation. Decentralized governance and reporting obligations. So this is more like big picture. A lot of these DPIN platforms are governed by a DAO, which there's still some, which I think I didn't catch the session, but I'm excited to go back and watch it. Jason Schwartz did one on the legal status of DAOs. But that's an interesting question, right? What are their reporting requirements if it is a DAO? Compliance with AML and KYC regulations. We obviously know that there's the broker reporting rules that are sort of in limbo at the moment, which could have implications. 6050I was also paused, but also some interesting implications there. And then international tax considerations, because these DPIN networks are truly global. So if you're participating in that network, say you're providing compute power to someone across the world, are you then subject to international tax? So really interesting considerations there. So and then DeSci, really a lot of the same questions, right? Revenue recognition, asset classification. So tokens or NFTs, are they intangible assets? Inventory, financial instruments, valuation and impairment. That's a factor in really all of these. R&D cost. So what do you capitalize versus what do you expense for research and development cost? Income recognition. So are they taxable upon receiving tokens, NFTs, as or they'd be taxable upon receiving tokens or NFTs as compensation. Capital gains, charitable contributions is also interesting because some of these are set up as nonprofits. So I'm just scratching the surface here. Again, we obviously didn't get into debits and credits or what like how certain transactions would be treated, but hopefully it gets your wheels turning on some of the implications here. All right, I am super excited about this next one. Gonna take a quick sip of water. All right. Okay, this one is really exciting. So restaking is a big narrative in DeFi. A lot of people are saying that it's sort of revived DeFi. We've seen DeFi kind of slow down. Obviously, it was a bear market. Essentially, what restaking is well, first, for those that are unfamiliar with staking, I assume hopefully we're somewhat familiar now, but staking is essentially just we'll use Ethereum, for example. You take some of your Ether, which is the native asset of the Ethereum blockchain. You essentially agree to lock that up, you stake it, in order to help provide security to the Ethereum network. And in return for doing that, you get paid interest for locking up your tokens. It can be referred to as an internet bond, right? So it's a appealing investment case there, because you not only can have Ethereum or ETH appreciate, but you can earn fees for staking. So the next kind of iteration of staking was liquid staking. So these are things like Rocket Pool, Lido. Essentially, what you can do is, to stake, traditionally you need 32 ETH, which is a large sum of money to stake, and it's very technical. You have to figure out how to like run your own node, all of this stuff. So with liquid staking, you can essentially take any amount of ETH, stake it through Lido, which is basically just like a staking aggregator. Probably not the correct technical term, but you can stake your tokens, and then from there the reason they call it liquid staking is you can then go take your Lido staked ETH or your Rocket Pool staked ETH or your Coinbase staked ETH and go and stake it somewhere else, or continue to earn interest. And it's really complicated from an accounting perspective because it's a daily rebasing token, meaning that you deposit your ETH, you get a staked ETH token, which rebases daily, meaning I agree, Taylor, those are scary derivatives. Meaning that every day at a certain time, those token values will change to reflect the amount of interest that you have gained on your stake. All right, so we haven't even talked about restaking yet. Restaking is the idea of essentially being able to take your staked Ether and you can go and stake it even again. So the main protocol that made this possible is EigenLayer. And so the diagram here is pretty helpful. So if you're a staker, you can go and stake your Ethereum and stake it on EigenLayer. And so essentially what EigenLayer allows for is for other networks. Well, let me back up. One of the problems that new networks have, especially that are just getting started, is security, right? It's really hard to get to the level of security that Ethereum has when you're just bootstrapping a network, because you need a lot of users, you need a lot of staked tokens. And so what EigenLayer does is, I really did miss the stake pun. I'm tired of them. What EigenLayer does is it essentially allows these startup protocols to borrow Ethereum security. So if you decided to go and start a proof of stake network and you didn't want to raise a bunch of capital, you could then go tap into EigenLayer's staked ETH or restaked ETH, and have all of the security of Ethereum. Hopefully I explained that well enough. So these liquid restaking tokens on EigenLayer protocol enable networks to use Ethereum security. What's pretty insane is EigenLayer has just seen some crazy inflows. So they facilitate over 7 billion in ETH restaking, representing 1.5% of ETH in circulation. So they've intentionally had to cap funds. Like you can't go and stake Lido staked ETH in there right now. So the pros of this are additional rewards, lower startup costs of new protocols, and then these new protocols can retain their sovereignty and sort of build things how they want. Now, there's some major cons with this model, right? This idea of taking your staked ether and going staking it again, and then providing security for all these actively validated services. That's a term that is used a lot with restaking. Actively validated services are essentially just a fancy name for dApps or applications built that need active validation. So one of the major cons is the classic principal agent problem. So to give you guys an example, there's a new poll up, by the way. So to give you guys an example, if I were to go and stake ether on Lido, I would get Lido staked ETH. I can then go and stake that Lido staked ETH on EigenLayer and go provide security for all of these different actively validated services. And there can be really an unlimited amount of actively validated services. So the benefit for me is not only do I have hopefully price appreciation of Ether, I have interest that I'm earning on my Lido staked ETH, which again, that's where the rebasing token comes in. And then I can gain additional interest for providing essentially additional yield for through EigenLayer as well. And then there's another part of this, points, which we'll get to in a second. But the major con here is the way that staking works is there's slashing risk. So slashing is if you're a validator, again, we talked about staking, you have your ether locked up. If you do something incorrectly or you're not you're like validating transactions that aren't valid, some of that ETH that you have locked up can get slashed. You will lose it for bad behavior. So the risk here is that you're trusting EigenLayer to go and pick these actively validated services. They could be completely shady, bad actors. SBF might start something from jail, and next thing you know, your ETH is getting slashed. So high risk, high reward situation. Popular platforms: EigenLayer, Puffer, EtherFi, KelpDAO. Hopefully I explained that okay. We can talk about this a little bit more in Q&A. We have some time. So here is overview of the liquid restaking ecosystem. There's a couple different platforms. Now, tax and accounting implications for this are pretty insane. So from an accounting perspective, ownership of restaked tokens is really interesting because do you really own your ETH or your Lido staked ETH or your Rocket Pool ETH if there's a high likelihood of slashing, right? And maybe there's something in the future where you have a slashing contra account, similar to like an allowance for doubtful accounts, right? So that's really interesting because at any point you could lose your staked ETH to no fault of your own, literally just because you are trusting an agent to go and essentially chase yield with your staked ether. So another really interesting thing is these platforms, these like bootstrapped platforms have started offering points. for essentially in return for providing security to their networks. And these points really don't, they're not tokens. Really, all they are is just, you're not receiving like the native token of that protocol. They're essentially just saying, hey, you could get an airdrop in the future. These points can be traded as well. So there's platforms to trade these points. So there's a potential that you receive an airdrop, but no promise of that. So the question becomes, how do you value those, right? Do you include them on your balance sheet? If so, what is the fair market value of those points? From a tax perspective, what is the cost basis of those points? Is there a taxable event if they're traded? It's all really interesting. So yield on yield on yield is another implication. So you can get not only the price fluctuations of Ether, you get interest from staked ETH on Lido. That's a rebasing token, and then you essentially have another rebasing on top of the rebasing. So it can just get really, really complicated. So from a tax perspective, income recognition is interesting. At what point do you exercise dominion and control of the rewards? That's kind of in line with the new recently released staking guidance. Taxation of points, talked about that. We're probably going to see even higher transaction volumes when you get people that are starting to like do yield stacking. And then always an interesting question is receiving a liquid restaking token in exchange for Lido staked ETH a taxable event? And yes, Taylor, you were exactly right. Rebase is one of those clear examples where an accountant was not involved. It's like, how do we make this as complex as possible? I won't get into these too much, but another obvious trend is you're starting to see institutions just flood into Bitcoin. Just, I think it was last week, 2 weeks ago, a very powerful banking trade coalition sent the SEC a letter asking them to repeal SAB 121 so that they could custody Bitcoin. So that's interesting. And then just really quickly, the spot Bitcoin ETFs are seeing a ton of volume. They now hold 260,000 Bitcoin. I think that number is probably even higher since I wrote this, worth 13.3 billion. They have surpassed Michael Saylor's 190,000. See that on the right, which also just is testament to show like Michael Saylor has a lot of Bitcoin.